Well, hey everybody, we are live. We are live currently right now in financial literacy for women business owners. We are also live on my Facebook. Well, that's my Facebook group. We're also live on my YouTube channel, Jamie Trolls. So wherever you tune in from, tell us you're here. Tell us you can hear us before we get started. And I'm really excited about today. We had a lot of interest in today's topic. We get a lot of questions about today's topic, so I wanted to bring on one of my esteemed preferred vendors. So I'll wait for people to jump on, and then I'll give. I don't want anybody to miss your intro, Mernie. I want everybody to know who you are. So as you guys are jumping on, tell us you can hear us. We were trying to work out some sound issues a little bit ago, so just let us know that you can hear us. And then we will get started. Okay, great. So I see some people jumping on, but I don't see comments yet. So let me know when you guys can hear us. And you guys, we have slides today. Mernie made us like slides. We're getting legit up in here.
Overachiever over here.
Yeah, exactly. I love that. Okay, so we've got some people, but it doesn't look like we need to wait just probably another, 30 seconds or so for everybody to join. So if you're watching this on replay, just like fast forward through this part while we wait for people. So it's Wednesday, 10 a.m. This is my typical session to come and teach you guys. But because of what the topic is, I wanted to bring in somebody who specializes in this. So I think saving for retirement is such a critical thing to do. And you also want to do it correctly, and you want to know what your goals are. And so we're going to talk a little bit about that with Mernie, about the different types of retirement plans and the differences between them. It looks like, and maybe that's the problem. Maybe Facebook's not coming through. Oh, I see Stacy on Facebook. Hang on, let me just check the group and make sure that everything is up and running. I want to make sure I can see us in the group because yep, I see us. Okay. So yes, we should be there. I see Stacy over there. Awesome. Okay. So anyway, I'm going to quickly do an intro, Mernie. Mernie is one of our preferred vendors. Mernie is a financial professional is what you call yourself. What would you call yourself? An investment advisor? What's your typical title, Mernie?
Well, broadly speaking, I use financial professional because it kind of covers a lot of different areas. So that's kind of my general title that I use. Yeah.
You're like a jack of all trades. So all the things, financial professional. She's been doing this over 20 years, you guys. She knows what she is doing. She is an entrepreneur. So she gets being an entrepreneur. She doesn't only work exclusively with entrepreneurs, but I think, you like I love to focus on, people who are entrepreneurs, small business owners, helping them. And so today we're going to be talking really about kind of an overview of different retirement type accounts. So that's something that I think everybody, it can be really confusing to figure out what is the right type of retirement account for me. What should I be doing with regards to retirement? What's best from a tax perspective? And that can be a little bit nuanced. So we'll talk about that as well. And yeah, so I'm going to turn it over to you, Mernie, to give us your intro of yourself. So I gave you a little one, but I'm going to let you intro yourself a little bit as well. And then we're going to jump right on into it and get up the slides, which I'm really excited to have.
Sounds good. Well, hey, everybody, Mernie here. And, thank you, Jamie, for having me. I'm very excited to spend this time with you this morning. It's 10 o'clock where you are. It's 8 o'clock where I am. So bright and early here on the West Coast. And waiting for the coffee to still kick in. So you'll probably notice once that kicks in as well. So yeah, just very excited about being here with you. Now, if you would have talked to me 21, 22 years ago about this topic, I would have told you I have no idea what you're talking about. So growing up, I actually had no idea what financial services was, or that it even was an industry. Because ever since I was 4 years old, the thing that I wanted to be when I grew up was a doctor. So that was my whole thinking, even all through high school. Everything I did was in preparation to become a doctor, because in my mind, the only people that helped people were doctors, because you don't feel well, you see a doctor, you feel much better. And so my first semester in college, going to be pre-med, I realized a couple of things. Number one, I'm not very good at biology and chemistry, which is a challenge if you're going to be a doctor. And at the same time, there is this, I guess, this creation of this perfect storm. So my mom, who has been a teacher her whole life, she actually got into financial services. And so she introduced me to what she was going to be doing. And it just, again, didn't make any sense. So I had no idea. I didn't even think that you have to plan for retirement. I just thought it's something that happens for everybody, right? It's not, your hair turns gray enough and one day you just retire and that's just how it is. And so I had no idea that all the things that go into it. And so as far as a financial professional, I think that is a broad term. And the analogy that I use, or the way I look at it is, we call a lot of people, for example, medical professionals, we call them doctors, even though they may have different specialties or they may have different level of education or specialization. And so that's the same thing with the term financial professional. So you have those financial professionals that may be focused more on the insurance side of things. And you may have those that specialize exclusively on the investment side of things. And then there are those professionals like myself that are well-versed in both. And so they can provide just a broader scope of services to their clients. And so that was my beginning into financial services, was basically coming into something I had no idea about, any of this stuff. And it's definitely been a great journey over the past 20 years or so. And so I'm a very different person today. I ended up switching and eventually ending up with a degree in economics, which is a lot more helpful in this world, as you know. And but that's what excites me, is when I sit with somebody who maybe has never heard of any of these things, or maybe hasn't done any planning, or maybe they already have some kind of planning, but they just don't really know what they have or understand it. So I think that's where education first is very important, so that at least they have a basic understanding of where they are, so that they can plan better for where they want to go.
I love that, Mernie, and I love your focus on education, because I think that is so important. I think a lot of times when, and that's something that I look for when I pick my preferred vendors. One of the questions I always ask, and I'm pretty sure I asked you, we had a conversation about it, which was just that dedication to educating. It's offering services, yes, but what I want to do is really help people to understand, right? And help people to really feel like they get what's going on. They have control over their financial decisions. And yes, they have somebody who can help guide them through that, but also help them understand that. And I loved your same commitment to financial literacy, right? In various different ways. So I focus on it from a standpoint of business finances. You focus on it from a standpoint of, investment planning and all kinds of different things from a personal finance perspective. And I think they're both so, so important. And I think that everybody should have somebody in their life like Mernie. And if you don't, you can call Mernie up. But everybody should have somebody in their life like Mernie that you trust to help you make some of those decisions around your financial future. Because y'all, like Mernie said, we all want to retire at some point, right? We all want to be able to retire. And the truth about that is we have to prepare for that. It's not something that can just happen without proper preparation. So we're going to get into the slides, and then I'll take questions. So if you guys want to ask any of your questions that you have in the chat, we will get to those at the end. But I'm going to put Mernie, I'm going to put your slides on up so we can get to some of the core content first. Hang on, I will present. There we go. All right, so we're going to start because we got fancy slides from Mernie, y'all.
Fancy yet simple. Yeah, so I want to keep it very high level. And of course, I think all of this goes without saying, but I'm going to say it anyways, that anything we discuss today is really meant to be educational. So if you do have specific concerns for your situation, the best thing to do is to consult with some kind of financial professional so that they can give you guidance based on your specific needs. But generally speaking, these things are out there and apply to everybody in some way. But as far as any specifics, that's when a real good professional will come handy. So we're gonna talk about our favorite topic, the topic that everybody loves, which is taxes, right? The one thing that I think people have in common when it comes to taxes is that nobody really likes paying for taxes, yet it's something that we always still have to deal with at some point. But when it comes to our retirement, just understanding how different things are taxed can make a huge difference in the strategic decisions that we make, and specifically decisions that down the road determine how much we actually end up holding on to and keeping in retirement, how much we end up paying to the government in the form of taxes, and then ultimately what we end up keeping and perhaps passing on to our kids or leaving a legacy, for other people down the road once we're no longer here. So just understanding how these different vehicles work, I think, is a huge part of that education that's missing a lot of the times. And so that's where, that's basically where it kind of begins. So if you want to just jump on to the next one, I'll show you what I mean in a little example here. Yep. So if I were to use this as an example, let's say, Jamie, you and I are 29, even though we haven't turned 29 yet, right?
Of course.
We're 29 years old.
Eternally
And,
29.
yeah, totally. So let's say at 29, we have saved $10,000, or perhaps grandma gave us a little inheritance, and now we have this little lump sum of $10,000 that we're earmarking for the future. So we promise ourselves that we're not going to touch this until we turn 65. And so if we take a look at it, if we were to look at it through the eyes of, let's say, a farmer, the question would be, which would you rather pay taxes on, the seed or the harvest? And so a lot of times when it comes to our money, we don't understand this concept. So of course, if I were to ask you, Jamie, would you like to pay taxes on something that's small, or do you want to pay taxes on something that's big? The obvious answer to you would probably be
the smaller one.
Smaller one, right?
Yeah.
And so that's basically how that is. And so if we were to actually just invest that money and earn an average rate of return of 9%, by the time we turn 65, our $10,000 would turn into $250,000 thanks to compounded interest. And so if we pay taxes on that $10,000, obviously the amount would be a lot less versus waiting and then paying taxes on that $250,000. And so there's three options I basically have when it comes to your retirement savings. You can either pay taxes now, or you can pay them later, or you can pay never. And of course, there's no such thing as never being taxed. I'll explain what I mean by that. But if you want to jump on to the next slide, I think that might help illustrate a little bit better.
Yeah.
Yeah. So here is actually where we're going to spend a little bit of time, and I think we'll probably end up having some questions maybe on this. So when I talk about tax now, tax later, and tax never, we're talking about money that has already been taxed. So even with taxable accounts, we're talking about investments that are being made from either your income from a business. So a lot of people obviously in this group are business owners. So this could be income from you, from your source of self-employment as a sole proprietor or any kind of business entity that you have set up. Or it could also be income that you have from employer, or if you're working for somebody else, you get a salary, you have wages. All of that money typically has already been taxed, and then now you're able to take that and invest that. So if you're investing that in taxable accounts, they're typically referred to as non-qualified accounts. And the easiest way to remember that, or to think of that, is basically non-qualified accounts typically do not have an immediate tax benefit for you. So your money has already been taxed. You're not going to take a chunk of that. You're investing it in some kind of a taxable account. And so again, generally speaking, these are things like stocks, bonds, mutual funds, and ETFs, a whole bunch of things that fall into that category. Now, every single year as those accounts are growing, as you're earning interest or perhaps getting dividends, you're going to get taxed along the way. So every year you typically receive a 1099 and then just pay those taxes that are due. And so it's kind of like taking a few steps forwards and then taking a couple steps back, because you're constantly paying as you go.
Yeah. So I think the thing with taxable accounts and how, because so I've got, I guess, kind of all of these different things that we're going to talk about, and we'll talk about whether that makes sense if you want one or both or all of them. But so for example, what I put in my kind of taxable account, so this is just like my general brokerage type accounts, or even, I guess technically even like your just checking and savings sort of counts as the same thing, right? I guess it's not an investment account, but ultimately that's money that is not, it's not tax advantaged in any way. But it's liquid, right? So that's the benefit of not putting that money into a retirement account, is if you're going to need it potentially at some point in the nearer future, right? That's generally what we use ours for. So when we don't put them into kind of tax deferred accounts or any retirement plans and things like that, it's because we want to be able to have some cash for more short term usage, right?
Right. So you hit the nail right on the head there. So yes, typically I would also include things like checking accounts and savings accounts, CDs, money markets, because traditionally those type of vehicles used to pay us some kind of interest. The reason why right now maybe most checking accounts or saving accounts are not being taxed is because the interest rates on those are so low. So if you get less than, I believe, $10 in interest, they're not going to necessarily send you a 1099 for the interest earned on your account. And so if you have a savings account, national average, I think it's about 0.09. I think it's even gone down from there. So, most people are not getting huge 1099s for their savings accounts, but you are correct. And that is basically one of the main reasons that you want to contribute into those kinds of accounts or have those accounts is mainly for liquidity.
Yeah.
Because we do need to have money on hand for emergencies and anything else, short-term type goals that we have.
And since you mentioned that, I think we've got a lot of questions into the group about is there a high yield savings account? I mean, in general savings accounts right now, because interest rates are low, you're not going to find even high yield accounts are not really going to give you all that much, right, Mernie? From a money market perspective or savings perspective.
Yeah, and I think right now, just based on the environment that we're in, what I think most people are finding for those kinds of accounts are more of the online only type bank accounts. So, people can probably do a search and see which ones, offer the best rates, but that's typically what we see because for the typical brick and mortar, banking institutions, it's just not, I think, feasible for them to pay any amount of, and of course, if you have high amounts, high levels of money in there, that's a different story. But we're talking about the average, family out there, the average business owner. They may not want to have 6 or 7 figures sitting, in their savings account at the bank if it's not earning very much for them. So,
yeah, absolutely. Okay, so let's move on then to the next one. I guess the qualified retirement plans.
Yeah, so actually it's the tax never category. So typically with most accounts that are considered non-qualified, they're basically taxed as they go along. There's actually one exception, so I'm going to skip to that one first, and then we'll come back to talk about qualified plans. So the one exception are actually non-qualified annuities, which is that last icon that you see there. So the thing with non-qualified annuities is that the money goes in after tax, and so whatever you contribute will grow tax deferred. And then when you go to take the money out, typically at retirement, you would only pay taxes on the gains. So even though when you're taking income out, a portion of that will be considered return of what you've put in or return of principal, and whatever is considered earnings or interest or investment performance, depending on how it's set up, you would only pay taxes on that. So there is, I guess, the exception to the rule is you can still have a non-qualified account and still have that tax deferral, but annuities are typically the vehicle that allow you to do that. And of course, there are so many different kinds, and there's so many different ones that have various benefits. So with this, I would say it's really important to work with somebody that really understand these vehicles in and out, because if you don't set it up properly, it may not have the effect that you're looking, for that to have for you. And I know, and I bring that up because I know sometimes that's another area of maybe a lot of misinformation or contradicting information, where some people say annuities always bad and some people say no, always good. There's no such thing with something always being good or always being bad. It just really depends on how it's set up and how that fits in to that person's overall financial situation. But typically, where and I think this is where you're probably going to go, who this might fit for, right? Is probably what you want to ask me. So I would say there are a few different scenarios that come to mind with this. So one thing is if somebody, for example, has never really had large amounts of money, and all of a sudden maybe they come into an inheritance, or they have like a lawsuit and they now got a huge settlement or something like that, somehow they get a huge windfall. One of the things that they can do, and actually another category that people don't think about, is also with people that are professional athletes. So all of a sudden they have a big windfall come into their lap, and if they want to make sure that they have some kind of money that they're never going to outlive, it might make sense to put a portion of that into an annuity, because that's basically what it is. An annuity is something that you typically start with a lump sum, although there are some that you can add into over time. But the idea is that at some point when you turn that income on, it's going to provide you with a lifetime of income that you can never outlive. And then, of course, depending on how it's structured, there's a whole bunch of other type of benefits that you can tie into that. But for a lot of people that maybe don't have the discipline, or perhaps they don't have a pension through where they work, this could be another way that they can set it up to kind of mimic like a private pension. But of course, if it's set up properly, it can give you a whole lot of other type of benefits that you typically don't get with other vehicles.
Yeah. So I think that's an important thing, because I think annuities are something a lot of people don't really look at, maybe, or don't really understand what they are. So if you were to just describe like what exactly is an annuity, how does that impact you? How would you describe that to people if they aren't familiar with it?
Okay, so actually one of the simplest way when I first learned what annuities were, this is how they're described to me. So most people understand what a life insurance policy is, because we understand that you pay small amounts of premium to a life insurance policy, and then should somebody pass away, there's a big payout. So you get a lump sum at the end. So if you think of annuities, it's almost the reverse of that. So typically with annuities, you start with a big lump sum, and then over time, you're now going to draw little bits of income from that over your, let's say, lifetime. So the way that it really made sense to me is just looking at it as a reverse life insurance. So with life insurance, we're protecting against passing away too soon. And with an annuity, we're actually protecting against, living too long. So if we happen to screw up and live longer than we're supposed to, then we have this income that we are not able to outlive. And so I think that's maybe visually that helps people think of what an annuity, what it does basically.
So Annie is asking a question on this specifically, and she asks, is there a recommended minimum lump sum to open an annuity? Would you say there's a minimum?
Well, depending on the companies, all companies have their own set of minimums. But I would say if you're looking to, and it kind of it goes back to the favorite, I guess, responses, it depends, right? Because it really depends on what your goal is for that particular annuity. So again, this is where you really need to sit down with someone who understands these vehicles inside and out, and also understands what you're trying to accomplish with it. Because there are some annuities, and just again, keep it very high level. There are some that you can use even if you're not planning on taking an income from it. So there are some that are more earmarked for investment only annuities and some other variations of that. So it really comes down to what is your goal for that money, and what are you looking for that amount, for that account to do for you. So if your plan is to draw an income from it, the obvious answer, I guess, would be the more you put in, the more you can get out of it in the form of an income. But the minimum to start it really depends on, are you just looking for temporary tax deferral? Are you looking for lifetime income? And, what exactly are you looking to do with that money?
Yeah. I love that though, too. I think an annuity can help just with responsibly using, like you said, a big lump sum payment. If you get, in big inheritance, like you said, or you come into a lot of money at one point in time, right? What is our inclination? Oftentimes, I mean, it's usually probably too much to be able to like put into a retirement account, right? At one point in time. So it's a matter of figuring out, okay, how do I do this in a way that it's going to be, have some tax advantages, and also help, like almost protect us from ourselves, I guess, right? To say, I'm not going to touch this money. I'm going to have it paid out to me over time. So that's an interesting thought about annuities and how they could be used, for your benefit. Okay, so let's talk about what's the next one you want to talk about?
So let's jump into that middle category of qualified retirement plans. And so as you can probably see listed on there, the typical plans that people think of when we think of qualified retirement plans, 401k, 403b, 457, a lot of those type of accounts have to do with where we work. So typically, if you work for a private company, if your employer has any kind of retirement plans, the typical one that they offer is a 401k. Now, if you happen to work for a nonprofit or hospital or like education system, typically they'll offer a 403b, and then government agencies tend to utilize 457. As far as taxation, all of these accounts are considered the same thing, basically, as far as how they're taxed. And then, of course, when we talk about self-employed or business owners, the couple of plans are not listed on here are SEP IRA and Simple IRA. So a lot of times for small business owners, those may be the vehicles that are more feasible for them to set up rather than, let's say, a 401k. Although you are able to set up even as a sole proprietor, or even with a business owner with no employees, you are able to set up like a solo 401k. But these all kind of fall into the same category. And then, of course, if let's say you don't have a retirement plan available to you, and perhaps you don't have the funds to set up like a group plan at this moment for your small business, then you have the traditional IRA, the individual retirement arrangements that allow you to save for retirement, even if you don't have an employer that is contributing for you or setting that up for you. The one thing with qualified plans, no matter what kind they are, is that you have to have some kind of earned income to be able to contribute to them.
Yep. And typically these are oftentimes the things that we talk about when we're talking about like tax savings, right? When people are looking for tax savings in the current year, one of the vehicles for that can be one of these types of qualified plans. And what that means is you put money into it now, right? And you aren't paying taxes on that income now. You basically get kind of tax advantages today, right? You save on taxes today, but you do pay taxes later, right? That's what we're saying. So we're paying when you actually take that out, and when you're paying, then you'll be paying taxes on the earnings that you had, and the whole thing, really, right? Like the entire thing, you're going to pay taxes on if you're using one of these types of qualified retirement plans, right?
Yeah, so there are a lot of rules when it comes to qualified plans. One of the rules is, typically you can't access the money until 59 and a half. And of course, there are always exceptions and things that may be available, but generally speaking, they're meant to not be touched until at least 59 and a half. And actually the same goes for annuities. So you get that tax deferral. The caveat is you have to wait until 59 and a half in order to be able to take advantage of those tax savings without having to pay penalties. And so you have those rules in place. And I think part of that is also to save you from yourself, because a lot of times if we have access to things, like our savings, they become what I call put-to-take accounts. You put it in and you take it out as soon as you need it. Or, some situations, it may not even be an emergency or whatever. It just might be you really want to get something, so you dip into things. And so these accounts kind of have these guardrails in place so that they save us from doing things that we shouldn't be doing with our long-term money. So that's why some of these things are in place. And of course, anytime we have tax benefits, there are rules that we have to follow. So as long as you follow the rules, then the vehicles, could really work for your benefit.
Yep, absolutely.
Yeah. And then the other things I wanted to say about qualified plans is, of course, if you're working for somebody else and they offer you a match, the place where this might, really be a good vehicle for you is if you work for somebody else and they're giving you a match. I typically say, in most situations, take the full match, because that's free money that's given to you. That's basically a guaranteed rate of return on your money. Now, if you are the employer or the business owner, then you are kind of in control of how you set that up. And so you can actually set it up where you have lots of benefits. And of course, if you have employees, you can also, it could be a win-win situation where you're setting it up where you get benefits, but also your employees are getting the benefit of having access to your plan as well.
Yeah, I have always been, that's kind of the number one thing around tax planning is if you have any kind of match, if you or your spouse or anybody has a match through their employer, max that out first. Like that should be the very first thing, because that's free money, right? Like that's free money. And I had an employer. Yeah, I had an employer at one point that you didn't even have to contribute, and they would put a percentage in. I mean, it was fantastic. So definitely take advantage of free money, because we all like that. So how do people know? I think this is one of the questions I get too, and this is kind of a little bit of a can of worms, and I have a feeling I know what you're going to say. But how do people know what type of plan is right for them? If they're a business, let's talk specifically about someone who's a business owner, and maybe they have employees, maybe they don't. How do they know what plan they should set up for themselves?
Yeah, so you probably know I'm already going to go with my favorite response is really, it depends. And there's different things that you want to take a look at as the business owner, because one of the things is usually a good starting point is how much are you looking to contribute? Now, if somebody is looking to start with a small plan, then they probably want to go with something that's a little bit easier to implement and also administer. So perhaps if you are a business owner and you've never had any other type of retirement accounts, I would take a look at and comparing to see if it makes sense to start with a SEP IRA or perhaps even just a traditional IRA, because depending on the amounts that you're looking to contribute, sometimes you may just be better off starting with that individual account. The good thing is you can actually exchange between these. So let's say you start with an IRA this year, and then you decide to open a SEP, you can basically take your money from your IRA and then roll that into your SEP IRA to jumpstart that. The other thing also is depending on when you would like those tax deductions. So if you still are looking for tax deductions for 2020, you are still able to do that with a couple of different things. You have the traditional IRA, which you have until the tax filing deadline, so until basically April, to make those contributions, or you can still make those contributions to a SEP. So if it makes sense for you as a business to contribute to a SEP IRA, and typically it's for people that either have no employees or have a few employees, because one caveat to that is that they would have to contribute to everybody. So if they have full-time employees that have been with them for a certain amount of time, they basically have to make it fair and contribute for everybody, on their behalf. So again, it depends on your situation and what you're looking to accomplish. But for those people that are still looking for tax breaks for 2020, because some people made more money than they were expecting to for last year, and they're actually in a situation where they're needing to maybe have some tax savings for 2020, you still have time to do that. And typically we say April, just so people think about April, but if you file an extension, you technically have until extension deadline to make those contributions.
Yes, you usually do. Do you have to have the account set up though by the end of the year? Because usually you can contribute for like 2020, people can still contribute generally up until they file their taxes, right? But they probably do need to have the account open in most cases, or can you open the account this year and contribute for last year?
So for SEP IRA and traditional IRA, you can still set it up now and still have it earmarked for 2020.
Nice.
So that's the benefit. So if somebody, let's say, wanted a solo 401k or a simple IRA or something like that, but they didn't set it up last year, but they still want 2020 deductions, they can actually set up a SEP IRA at this point, perhaps make the max contribution they can to that, and then later this year, they can convert that into a 401k or any other type of plan that they want to.
Awesome. That's great. Okay, we have a couple of questions, so I'm going to put these up on the screen because they relate to what we're talking about right now. So somebody, and I can't see your name, if you want to give StreamYard permission to see your name within the group, it'll show your name up here, but says, what's the difference between an IRA and a SEP IRA? How would you explain that?
Okay, so just think of an IRA as anybody that has earned income is able to contribute to an IRA, and we call them traditional IRAs, and because there's two different kinds of IRAs typically. So when we talk about traditional IRAs, or the one that gives you tax savings today, if you're currently less than 50 years old, you are able to contribute up to $6,000 into an IRA. If you're 50 and over, you get an extra $1,000 catch up. So for 2020, for example, if you're 50 and over, you can put a max of $7,000 into that. The one thing is, let's say somebody only has passive income, or they have basically what's considered not earned income, then they're not able to contribute to any kind of qualified plan, really. So the difference between that and a SEP IRA is that with the SEP IRA, it's considered an employer plan. So it's typically who uses that is a small business owner. Now, if you're an independent contractor and it's just you can set up a SEP IRA. But if you're only an employee with W-2 income only, then you're typically not going to set up a SEP IRA unless, again, you have a business and you're getting a W-2 from your business. Then technically your business as the employer would set up the plan and then contribute on your behalf as the employee. So if there's no business involved, then you can't do SEP IRA.
Yeah, and the thing about a SEP IRA too, I have a SEP IRA. And depending on how much you make, the amount that you can contribute, we're not going to get into contribution limits here because they get really, there's just a lot of different things. So you mentioned the traditional, right? You max out at 6,000 typically if you're under 50. Well, a SEP IRA maxes out quite a bit higher. So it depends again, though, on how much you make because it goes on a percentage of your earnings. So it can be, you can have the ability to put in quite a bit more. I think depending on if you make quite a bit of money, you're going to be able to even contribute up to, what is it, 57,000? Is that the limit?
So for 2020 is 57,000. 2021 it's bumped up to 58,000. So, but that is basically the max. So even, if you make 6-figure, 7-figure income, you basically just max out at that 57,000 for 2020. So that's, and of course, as you mentioned, it's a percentage. So the actual amount, because I get a lot of people that say, well, how much can I put into a SEP? And the answer really is, it basically depends on how much you're making and also what the source of that income is, because it does make a difference if it is W-2 income versus 1099 income.
Yeah. And I think this is a good question as well from Gloria. Gloria, who's another one of our amazing preferred vendors. Hey, Gloria. So what's the difference? And benefits between a SEP and a solo 401k. So when I was trying to decide, these were the two that were in front of me to say, which makes more sense, right? And again, some of this, when I was looking at it, it was kind of, there was a difference in how that in those contribution limits and how much I would be able to put into each one of them. And there's also a little bit of a difference in how easy they were to set up. So for my brokerage firm, the SEP was a lot easier to set up. And for me, I could put in more to a SEP, or relatively about the same amount. Actually, it kind of came out. So I went with the SEP. But solo 401k is a very similar type of product from my understanding, right? So how would you kind of describe what the main differences between those two things are? Because those are both open to business owners, typically who don't have employees. Now a SEP, right? I can have a SEP and have employees. However, I have to, at a certain point at least, offer them the same benefits that I'm giving myself, right?
Right.
And then with a solo 401k, you can't have employees. Is that correct?
So you can, with the solo, you can actually, if you're a husband and wife working together, you can technically contribute for both. But I would say the thing that keeps most people, if they're deciding between the two, just like you were, I think with the SEP, it's just the administration of it is a lot simpler and it's easier. With the 401k, once you get to certain account levels, you just have increased responsibility, and you want to make sure that all the reporting and all that stuff is done correctly. And typically what people see is also an increase in expenses when it comes to 401k. And so again, depending on the amounts, because it doesn't make sense if you are looking to contribute a smaller amount to go through the hassle and the expense of setting up a 401k when you can basically achieve the same desired effect with having a simpler plan such as a SEP IRA. So it just, kind of depends on what you're looking to accomplish with that money.
Okay, so somebody's asking, is a SEP taxed now or when you withdraw the funds in retirement?
Okay, so anything that's in this yellow category of taxed later, it basically means if you put the money in today, you have the benefit of saving taxes on that money today. But in exchange for that, you're going to pay taxes on all the money. So whatever you've put in, plus hopefully any interest that you've earned over that duration, 100% of your account becomes taxable at the time that you withdraw the funds. So typically in retirement, everything is taxable.
So I think this goes back to kind of the seed and the harvest you were talking about, right? Where in some cases, you're taxed later. Now, maybe you have a lower tax rate later, maybe not, it depends. But you're going to get taxed on the full amount later. So yes, you get a tax benefit now, but you will end up paying taxes on that money at a point in time. So I think that's just something for people to keep in mind, is that it's not a permanent deferral of taxes, right? You will have to pay that back later. I think most people hope, well, I should be able to do that later. It shouldn't be a problem. And so they take those tax benefits now, which is a typical kind of strategy that people use. And probably should be, right, part of your portfolio, right? So we talked about this a little bit, Mernie. So I want to get into kind of really quickly, like this tax now, tax later, tax never. Is one better than the other? Should you have a little bit of all of these things? And let me know if you want me to go to the next slide. I can't remember what's on it.
Yeah. Yeah, if you want to go ahead and skip to the next slide. So yeah, I think ideally you want somebody that can help you put together all of these, because it's not, you can't look at retirement as an account. I have one retirement account, so I'm all set. It's really a strategy. And also some of it has to do with timing and how you're looking to take those distributions. So a lot of times when we're thinking about taxes, we're just focusing on today and what that picture looks like today, because again, nobody likes to pay taxes, so we're all trying to save as much as we can today. However, it is the job of your financial professional to also kind of bring up the point of, right now we do want to have as much tax savings as we can, but what's going to happen in the future when we need to withdraw that money? Because a lot of times, since we're thinking of that instant gratification and getting the savings today, which is great, but when we think of the long term and when it comes to the distribution phase, that's where some of the challenges come up. If all of our money is, let's say, in the taxable, tax now, or tax later category, because we really have no control over what tax rates will be in the future. And so if all of our money will be subject to taxation in the future, our net result in retirement may not be what we expect it to be. We may have a huge nest egg, which is obviously the ultimate dream, right? To have a lot of money in retirement that we can then draw from and live our dreams. But unfortunately, the bigger that nest egg is in that middle category, in that yellow category, the more we'll end up paying in taxes. And sometimes the idea is, people say, well, I'm going to be in a lower tax bracket. Or the thing I hear a lot of the times, believe it or not, is, well, when you retire, you don't pay taxes. And so a lot of times people seem to think that it's tied to our age. And I tell people, look, if you're 100 years old and you still have income, you're still going to pay taxes. It doesn't care. Taxes don't discriminate, right? They don't care how old you are. If there is income that is subject to taxes, you're going to pay it regardless of age. So
Yes.
That is why this last category, the tax never category, it's marked as green because, green is the color for money and growth, right? So we like green. And so there are a couple of different vehicles that allow you to do this. I'm not going to spend too much time on government bonds. Because basically, in order to get the desired effect from those, you need to have really large amounts invested in these because the yield tends to be very small. And of course, with interest rates being where they are right now, for most people, that's not going to be the vehicle that's going to give them that desired effect. So it really comes down to two other types of vehicles that can achieve this effect for us. Roth IRAs are similar to traditional IRAs. The difference between a traditional IRA that we saw in the yellow category versus a Roth IRA is that with a Roth IRA, you actually don't get any tax savings the year that you make the contribution. So let's say, and you can still make contributions for 2020 into a Roth IRA, and the maximums are the same, $6,000 if you're under 50 and $7,000 if you're 50 and above. And also one little caveat with that is if you have both a traditional IRA and a Roth IRA, it's $6,000 or $7,000 total. So you could put 3 in each, or $2,000 in a traditional, and let's say $4,000 in a Roth IRA, but you can't do 6 and 6, right? So it's a total combination of both.
And then I think the other thing to note on here too, right, with Roths is that they have a pretty low, relatively phase out of when you can contribute, right, as far as your income levels go. And is that true with traditionals as well? I forgot to ask you that.
Yeah, so the deductibility part of it, it's basically the same threshold. So again, most people that are above, for 2020, the household income, it's at 206. So you start capping out at that. It went up a little bit for 2021 to 208. But actually, to let you know, as an individual, the phase out is for 2020 is 196 to 206, and it goes from 198 to 208 for 2021. So for people that make over those amounts, they basically aren't able to directly contribute to a Roth IRA. Now, there are some technical things that they can do. I don't even know if I want to get into that, but if somebody really wanted to have
you
Roth
can call
contributions,
Mernie if you want to know.
Yeah. But one other thing I will say though is that, and it's not on here, but what I've seen more that's becoming more popular is actually having a Roth provision inside of your 401k. So if you work for a company, if your employer's plan allows for Roth contributions, that is one way around the income. So with the 401k Roths, there's no income limitation. So if you are the small business owner and maybe your income is higher, you could set up a solo 401k that allows for both traditional tax deferred contributions and Roth contributions inside of your 401k.
And so I'll address this one around, IRA, like the tax versus not taxed. So importantly, the money is taxed that you're putting into a Roth IRA. It's already been taxed, right? So you're not getting any tax benefit this year, is what Mernie's saying, on anything put into a Roth. But you don't, on a Roth, right? Everything, as much as it grows. So again, going back to your $10,000 turning into $250,000, right? In a traditional, you'd pay, you would save taxes on the 10,000, but you'd pay taxes on the 250. In the case of a Roth, right, you aren't going to save anything on the 10,000, but you also aren't going to pay taxes on the 250 because you that will grow completely tax free. So that's why the Roth is a great type of vehicle for people, especially this always for me, like when I read about this as when I was younger, I got really into reading all the investment books and everything. And the younger you are, the more sense it makes to max out that dang Roth IRA because, right? I mean, your tax benefits now are probably not that significant versus what they will be later as that money grows over time. So I've always kind of seen it as this continuum. Now, that's not necessarily, it doesn't mean that when you're older, you don't want to contribute to a Roth because it can still be a really great vehicle. But definitely, if you're in your 20s, man, max that Roth out every single year. I did that when I was young. I started a Roth at the age of, I think, 17 or 18. And I have since I put some money in it. When I can, but it has grown ridiculously over time compared to what I originally put in it. So I think the Roth is a great thing. And I want to get to the permanent life insurance one, because this was one that I wasn't really familiar with, Mernie. And so I'd love for you to kind of talk through what exactly that is and how it can kind of achieve some of the same things, especially for people who can't contribute to Roths or are in that kind of situation. Talk to us a little bit about that.
Yeah, so it's it's been referred to as a couple of different things. So some people call it LIRP, life insurance retirement planning. Some people also call it rich man's Roth, right? Because if you aren't able to contribute to a Roth but still want to have similar tax benefits, permanent life insurance could be a vehicle that is used. But that also comes with, I would say, a few caveats, right? So first of all, when people think of permanent life insurance, the common mistake that I see a lot of times is that people assume or think that the only form of permanent life insurance is whole life. And that is not necessarily the case. There are actually other options for permanent life insurance. And so what I would advise with the life insurance is that, again, you get with somebody who really understands the different options and can explain that to you so that it's set up properly. Now, the other thing with life insurance, you can set it up for yourself as an individual, but as a business owner, there are also different ways that you can set it up. Sometimes as an executive bonus plan for employees. And even if you're the only employee, you can, depending on your structure, it may be something that benefits you. And perhaps as a key person, if you have key employees that you want to incentivize, to retain, there may be some great things that you can do with that. But basically with permanent life insurance, there has to be a couple of things in place first before that would make sense. The number one thing is that you have to have some kind of insurable need. So if somebody has no insurable need, then this would not be the appropriate vehicle for them. Now, people can have insurable needs for different things. So they may have personal insurable needs if they're looking to replace their income, if they have a family, if they have debt, if they have, something that needs to be taken care of in their life, if they're not there to take care of it, there may be a need for permanent life insurance. On the business side, though, just for the fact that you have a business, that actually might indicate that there may be a need for permanent life insurance because of some of the things that you're looking to do with your business, particularly also with business continuation. So if something were to happen to you, how do you want your business to continue? Or if you have partners, this could be a great way to actually determine ahead of time what would happen should something happen to one of the partners. So there are a lot of different uses for permanent life insurance. It can also be used for estate planning purposes. There are second to die policies that can be set up to really give you a multitude of benefits. But one of the most underlooked benefits of permanent life insurance is actually those the tax-free savings that you can accumulate inside of that. And again, this is where I say not all vehicles are created the same. So that's why you have to look at the plans and how you're getting that accumulation, because not all plans accumulate the same way. And in addition to that, besides the cash savings, there are now plans that offer what's called living benefits that you can combine with that. So another area of retirement that people don't think about is once they're retired, if they do have major medical needs and perhaps have need for things like long-term care or other type of chronic illness care, if they don't have something set up for that, that might eat into all of their savings and their nest egg basically that they've built. So permanent life insurance, it's also been referred to as a Swiss Army knife of financial strategies because you can get so many things built into it if it's structured properly. So again, you have to really make sure that you're setting it up. And number one, that you understand what you have, but you're also setting it up in a way that benefits you the most.
I love all of that. I think that's all really, really important. I'm going to put us both up here real quick because I want to wrap up because we've taken a lot of your time, Mernie, but this is really, really helpful. I think the moral of the story, and here's what I'm getting out of this and the conversations that we had as well is, I think sometimes we think like we just need a retirement account, right? We think of it in terms of an account, like you said, versus having a plan that is diversified in terms of different things that achieve different goals, right? But that all work towards the same goal, which is making sure that we're prepared for retirement. And so that kind of even got me thinking, because I thought like, oh, I'm good on retirement. I got, this fund and that. And now I'm like, oh, maybe I need to think about like some just different strategies and really dig into what makes sense for me. And I think the other thing that I'm getting from this too is that it's not one size fits all. Right. So it's not always never is whenever you hear people saying that it's always, we have to be a little bit careful because people's financial situations are different. It's the same thing with any kind of, CPA type situation. When people say always and never, it's usually not true. Those things exist for a reason. And there are situations where they can make sense, but you need to actually sit down with somebody and talk about your personal financial situation, all the ins and outs of it, to be able to come up with a plan that makes sense for you and is going to be the most advantageous for you to achieve your goals. Because remember, guys, we don't all have the same exact goals either. So we need to make sure that we aren't listening to just somebody else telling us what we should be doing and that we're sitting down and talking to a professional. So with that, I have linked Mernie's information. She's also on our preferred vendors. On our preferred vendors list. You guys can reach out to her. She does free consults. So you can just sit down and talk to Mernie about what maybe you should be doing and what she can help you do and just kind of talk through what that would look like. Again, I've linked all of her info below and you can just go and actually just book a little call with her and she'll talk you through. And like I said, what I love is Mernie loves education as much as I do. So she is happy to talk you through in a non-judgmental, like I said, non-judgmental way to help you learn what is best for you. So I highly recommend Mernie. I think she's awesome. And I'm so excited to have you here with us today.
Yeah, it's been fun. Thank you so much. As you can tell, I love this stuff and I can talk about it for hours and hours. But this is why, it's important to love what you do, because in that way you can serve people in the best way possible. So I really appreciate your time and for having me today.
Of course. I'm so glad to have you as a preferred vendor. It looks like other people are too. If we didn't get to your question, we can go back and maybe Mernie can take a look down through the question and see if there's any other ones that she can add some quick thoughts on for you guys. But like I said, just book a call with Mernie and she'll tell you all the things that you need to know. So anyway, thanks guys. I hope everybody has a wonderful, wonderful rest of your day. Happy Wednesday. And we will talk soon. I'll be back on Friday with my stimulus update and Q&A. So I'll see you guys then. Bye guys.